Hello and welcome to this webcast on IFRS 17 insurance contracts. Today we'll be providing a basic overview on measuring insurance contracts that have participation and other features. My name is Laura Kennedy and I'm an Assistant Technical Manager on the Insurance Contracts project.
My name is Anne McGeechan and I'm a Technical Principal on the Insurance Contracts project.
Before we start, as usual, the views expressed in this presentation are our own and not necessarily those of the International Accounting Standards Board or of the IFRS Foundation. This slide outlines the topics that will be covered in today's webcast. This webcast on insurance contracts with participation and other features is in two parts. You are listening to part 2. The features we'll be discussing are payments to policyholders that vary with returns on underlying items through participation features, financial options and guarantees, discretion over the timing or amount of cash flows, and cash flows affecting other contracts. We recommend listening to Part 1 before listening to this webcast. Part 1 is the introductory webcast that briefly explains the 4 features and explains their effect on the measurement of the fulfillment cash flows. In this webcast, Part 2, we discuss the effect of the 4 features on the measurement of the contractual service margin. We will also be discussing the criteria for the variable fee approach in this webcast.
Let's start with a reminder about contracts under IFRS 17. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Enforceability of the rights and obligations in a contract is a matter of law. An entity shall consider its substantive rights and obligations, whether they arise from a contract, law or regulation, when applying IFRS 17, including determining whether a contract has the features discussed in this webcast, and if so, to what extent. But an entity shall disregard terms that have no commercial substance, i.e. have no discernible effect on the economics of the contract. This applies when an entity considers how to classify a contract and when assessing the substantive rights and obligations for determining the cash flows in the boundary of a contract. Contracts can be written, oral, or implied by an entity's customary business practices. The practices and processes for establishing contracts with customers vary across legal jurisdictions, industries and entities. In addition, they may vary within an entity. For example, they may depend on the class of customer or the nature of the promised goods or services. IFRS 17 does not treat all insurance contracts with participation features in the same way. It uses the idea of direct participation features to determine the accounting treatment for insurance contracts. Contracts that have direct participation features as defined in IFRS 17 have specific requirements. Those specific requirements are called the variable fee approach in this webcast. Contracts without direct participation features apply the IFRS 17 core requirements. We will now look at the core requirements for the contractual service margin, followed by the requirements under the variable fee approach.
Let's now look at the effects of participation and other features on the contractual service margin applying the core requirements in IFRS 17. The same measurement requirements apply for contracts without participation features and contracts with participation features that are not direct participation features. As a reminder, under the IFRS 17 core requirements, insurance contracts are measured at the sum of 2 components, the fulfillment cash flows and the contractual service margin. The contractual service margin represents the unearned profit from providing services promised in the contracts. On day 1, it's the amount determined so that there is no gain recognised in profit or loss on the initial recognition of a group of insurance contracts. A webcast titled Core Requirements Measurement Essentials of IFRS 17, is available on our website, which provides background information. We recommend viewing that webcast before viewing today's webcast.
Let's start with a reminder of where subsequent changes in the fulfillment cash flows after initial recognition are recognised under the core requirements. Some changes adjust the contractual service margin, which is another component of the liability, and other changes are recognised in profit or loss, or, as an option, other comprehensive income. Let's start with the first column. Changes in the fulfillment cash flows related to future services. An example of a change related to future service is a change in the expected future discretionary cash flows to be paid to a policyholder. Such changes adjust the contractual service margin. We discuss this further in the next slide. The next column looks at changes in the effects of the time value of money and financial risk on the fulfillment cash flows. They do not relate to future service. They are recognised in profit or loss, or partly in other comprehensive income if the entity selects that option, as part of the insurance finance income or expenses. The entity does not adjust the contractual service margin to reflect the effects of changes in these assumptions. Accordingly, changes arising from participation features and financial options and guarantees do not adjust the contractual service margin to the extent that they relate to the time value of money and or financial risk. Let's move on to the final column. Changes in the fulfillment cash flows that relate to current and past service do not adjust the contractual service margin and are recognised in profit or loss. For example, changes in the estimates of the liability for incurred claims. IFRS 17 requires an entity to distinguish between the changes in assumptions that relate to financial risks, which do not adjust the contractual service margin, and the effective changes in expectations of future discretionary cash flows, which relate to future service and hence do adjust the contractual service margin. To distinguish between the two, IFRS 17 requires an entity to specify at the inception of a contract the basis on which it expects to determine its commitment under the contract, for example based on a fixed interest rate or on returns that vary based on specified asset returns. If the entity cannot specify such a basis, an entity assumes that the commitment is the return implicit in the estimated fulfillment cash flows, updated to reflect current assumptions for financial risk.
So far, we've discussed insurance contracts to which an entity is required to apply the IFRS 17 core requirements. We'll now move on to the requirements applicable only to insurance contracts with direct participation features. These requirements are called the variable fee approach in this webcast. This slide shows the criteria for the variable fee approach. An insurance contract with direct participation features is one that meets all of these criteria. We discuss the criteria in more detail in later slides. But first, we'll explain the underlying rationale for the variable fee approach and for its scope. Under the core requirements, the fee the entity receives for the services provided under the insurance contract is the premiums paid by the policyholders, less any investment components. Changes in the fair value of assets in which the premiums are invested do not affect the fee, and hence do not affect the revenue recognised for the contract. However, in some cases, insurance contracts are substantially investment-related service contracts, under which an entity promises an investment return based on underlying items. In these cases, the fee for the services provided under the insurance contract is regarded as being the entity's share of the underlying items, less any fulfillment cash flows that are not related to the underlying items. As we'll discuss later, this means that changes in the fair value of the underlying items do not affect the revenue recognised for the contract. The board used the criteria on the slide to identify those insurance contracts that are substantially investment-related service contracts. As a reminder, reinsurance contracts do not provide substantially investment-related services, so are excluded from the variable fee approach. Let's look now at the criteria in more detail. When is a contract assessed against the variable fee approach criteria? An entity assesses whether a contract meets the criteria at the inception of the contract. In this assessment, the entity will need to consider all the features of the contract. For example, if the contract has the fourth feature, that's whether the contract's cash flows affect or are affected by cash flows to other policyholders, it needs to consider whether it meets the criteria with the presence of this feature. As a reminder, in an earlier slide we noted that an entity needs to consider its substantive rights and obligations, whether they arise from a contract, law, or regulation when applying IFRS 17. This includes assessing when a contract meets the variable fee criteria. An entity is prohibited from reassessing whether a contract meets the variable fee criteria after initial recognition, unless specified modifications occur, in which case the entity must reassess. If you are interested in these specified modifications, please listen to our webcast entitled Core Requirements, Recognition and Derecognition, available on our website. There are three criteria that determine whether an insurance contract falls within the scope of the variable fee approach. An insurance contract must meet all three of these criteria. We will now discuss the criteria in turn.
The first criterion, criterion A, is that the contractual terms specify that the policyholder participates in a share of a clearly identified pool of underlying items. We will be discussing this criterion in the next few slides. A variable fee approach contract may have feature number 3, discretionary cash flows, whereby the entity has discretion to vary the amounts paid to the policyholder. This discretion does not preclude a policyholder from having a share in a clearly identified pool of underlying items. However, the link to the pool of underlying items must be enforceable. The pool of underlying items referred to in criterion A can comprise any items, for example, a reference portfolio of assets, the net assets of the entity, or a specified subset of the net assets of the entity. However, the pool must be clearly identified by the contract. An entity need not hold the identified pool of underlying items. It could be a reference portfolio of assets, for example, an index or a fund managed by another entity. Criterion A is not met, that is, a clearly identified pool of underlying items does not exist when an entity can change the underlying items that determine the amount of the entity's obligation with retrospective effect, or if there is no pool of underlying items identified, even if the policyholder could be provided with a return that generally reflects the entity's overall performance and expectations, or the performance and expectations of a subset of assets the entity holds. An example of such a return is a crediting rate or dividend payment set at the end of the period to which it relates. In this case, the obligation to the policyholder reflects the crediting rate or dividend amounts the entity has set, and does not reflect an identified pool of underlying items. Let's now move on to the other two criteria.
Next we have criterion B and C. Those are: the entity expects to pay an amount equal to a substantial share of the fair value returns on the underlying items, and the entity expects a substantial proportion of any change in the amounts to be paid to vary with the change in the fair value of the underlying items. Contracts with the following features are not precluded from meeting these criteria: contracts with a minimum guarantee return, and contracts with a return that is based on amortised cost of underlying items. We'll explain why in the next slide. When interpreting the term substantial in the criteria, this should be in the context of the objective of insurance contracts with direct participation features. That is, contracts under which the entity provides investment-related services and is compensated for the services by a fee that is determined by reference to the underlying items. Whether criterion B and C are met depends on the entity's expectations on a present value probability weighted average over the duration of the group of insurance contracts. So, if the guarantee of a minimum return was not expected to affect the cash flows, because it was not expected to kick in over the duration of the group of contracts, it would not stop the contract meeting these criteria. And if the return based on amortised cost was expected to equal the fair value return over the duration of the group of contracts, contracts providing such a return could meet these criteria.
So the scope of the variable fee approach identifies those contracts that provide substantially investment-related services. How does that affect the measurement of a group of insurance contracts? The requirements for the fulfillment cash flows for variable fee approach contracts are the same as the requirements for contracts measured applying the core requirements. The only difference is the subsequent measurement of the contractual service margin. The next few slides explain why and what the differences are. The board views these variable fee approach contracts as creating an obligation to pay policyholders an amount equal in value to specified underlying items, minus a variable fee for service. That fee is an amount equal to the entity's share of the fair value of the underlying items, minus any expected cash flows that do not vary directly with the underlying items. This view of the fee is why there is a difference in the subsequent adjustments in the contractual service margin between the contracts accounted for under the variable fee approach and those accounted for under the core requirements. We discuss this further in the next slides.
The board's view of the fee under variable fee approach contracts results in differences to the subsequent adjustments to the contractual service margin. The adjustments to the contractual service margin are the net of changes in the fair value of the underlying items and the fulfillment cash flows for the liability for remaining coverage. A simple example illustrating this is included in the appendix to the slides accompanying this webcast. We explain how these adjustments differ from those in the core requirements on the next slide. Applying the variable fee approach, the contractual service margin is adjusted for changes in the variable fee. This can be analysed as changes in the fulfillment cash flows related to future service, applying the core requirements, and additional adjustments for variable fee approach contracts. Those are for changes in the effect of the time value of money and financial risk not related to the underlying items, and changes in the entity's share of the fair value of underlying items. For variable fee approach contracts, an entity must adjust the contractual service margin for those additional adjustments. However, an entity can choose not to adjust the contractual service margin for some of those additional adjustments when specified risk mitigation conditions are met. We'll discuss those in the next slide. Amounts payable to policyholders create risks for an entity, particularly if the amounts payable are independent of the amounts that the entity receives from investments. For example, if the insurance contracts include guarantees. An entity is also at risk from possible changes in its share of the fair value returns on underlying items. An entity may purchase derivatives to mitigate such risks. Applying IFRS 9, such derivatives are measured at fair value. For contracts without direct participation features, the contractual service margin is not adjusted for the changes in the fulfillment cash flows that the derivatives are intended to mitigate. Hence, both the change in the carrying amount of fulfillment cash flows and the change in the value of the derivative will be recognised in the statements of financial performance. If the entity chooses to recognise all insurance finance income or expenses in profit or loss, there will be no accounting mismatch between the recognition of the change in the value of the derivative and the recognition of the change in the carrying amount of the insurance contracts. However, for contracts with direct participation features, the contractual service margin would be adjusted for the changes in the fulfillment cash flows, including changes that the derivatives are intended to mitigate. Consequently, the change in the value of the derivative would be recognised in profit or loss, but there would be no equivalent change in the carrying amount of the insurance contracts to recognise, creating an accounting mismatch. A similar accounting mismatch arises if the entity uses derivatives to mitigate risk arising from its share of the fair value returns on underlying items. To avoid such accounting mismatches created by the variable fee approach, IFRS 17 allows an entity not to adjust the contractual service margin for the changes in the fulfillment cash flows and the entity's share in the fair value return on the underlying items that the derivatives are intended to mitigate.
The option not to adjust the contractual service margin for some effects reduces the comparability of the measurement of insurance contracts, because the contractual service margin will be adjusted by a different amount depending on whether and the extent to which an entity chooses to apply this approach. To limit the reduction in comparability, the board decided that an entity may make this choice only to the extent that it has a previously documented risk management objective and strategy for using derivatives to mitigate financial market risk arising from those fulfillment cash flows, and the entity uses a derivative to mitigate the financial risk arising from the group of insurance contracts. An economic offset exists between the group of insurance contracts and the derivative, i.e. the values of the group of insurance contracts and the derivative generally move in opposite directions because they respond in a similar way to the changes in the risk being mitigated. And C, credit risk does not dominate the economic offset. Once the entity has chosen to apply the risk mitigation option, it must apply it consistently in each reporting period. If the conditions for being able to apply the risk mitigation option cease to be met, the entity can no longer apply the option. The entity does not make any adjustment to the effects recognised in previous periods. This risk mitigation option is only applicable for periods on or after the date of initial application of IFRS 17. It cannot be applied to periods before the date of initial application. This is because the board concluded that retrospective application of the risk mitigation treatment would give rise to the risk of hindsight.
The contractual service margin is recognised in profit or loss over the coverage period of the group of insurance contracts. A webcast focusing on the recognition of the contractual service margin in profit or loss is available on our website, and you may find it helpful to refer to that. That webcast looks at the core requirements, i.e. the requirements that apply to insurance contracts without direct participation features. The differences between those requirements and the variable fee approach requirements are that for variable fee approach contracts, the benefits to be considered in determining coverage units are insurance coverage and investment-related services, rather than just insurance coverage. And the coverage period includes periods in which investment-related services are provided, as well as periods in which insurance coverage is provided. The Board proposes to make a clarification to the definition of coverage period in IFRS 17 in respect of that point, as discussed at the June 2018 Board meeting. That's the end of this webcast, Insurance Contracts with Participation and Other Features, Part 2. We hope that you found it useful. Thank you for listening to today's webcast.
Thank you, and goodbye.